Welcome to Bloomberg Markets. I'm Shanali Bassick. An avalanche of earnings hitting investors today. Election uncertainty causing an overhang on a lot of things out there. Let's see where we stand with markets as we hit noon. On Wall Street, we have the S&P 500 near session highs, up about 0.3%. Of course, it doesn't seem like a ton, but you did see that exuberance in the market start to float in with strong economic data at the top of the 10. And remember, on Friday, we have jobs as well. So investors have their close eye on economic data. Interesting to see that the NASDAQ 100 is actually down about 0.1%. Remember, we had Alphabet earnings coming out with a bang, very positive. And even though it's floating higher, you have other idiosyncratic stories under the surface. You don't see as much love in the semiconductor index, and of course, Supermicro down by a lot. The 2-year yield at 4.14, a move of about 4 basis points. 10-year at 4.25, generally steady, but of course, that is not moving into the equity market, at least for today. To some midday movers on the equity side, we're going to bring in Bloomberg's Abby. They'll do a little for that.
Well, let's take a look, Shanali, at one of the big movers on the day out of earnings. Alphabet up more than 5%, its best day since April of this year. They beat earnings, adjusted earnings by 7%. They beat sales by more than 2%. Importantly, search was strong, the cloud was strong, and lots of other details for different analysts. Morgan Stanley really liking the YouTube results, while Barclays highlights AI. Turning to one stock doing less well, though, AMD right now down about 9.6%, the worst day since July of this year. They basically put up an inline quarter. The guide for this current quarter below what expectations had been by a little bit, but the big piece of it is that the AI contribution not as strong as analysts were hoping for. And at the lows, this stock, in fact, had been down more than 10% at that point, heading to its worst day since October of 2022. And then finally, the big one, Supermicro Computers. This stock is absolutely plunging down 32.4%. Ernest & Young, their auditor, resigned, citing integrity concerns around governance and transparency. All of this, of course, follows the Hindenburg short around the idea that they would be delaying their financials, which they have done. Woo Jin Ho, our BI analyst, Shanali, told me a few weeks ago that he thought that this was just a case of a small company becoming too big too fast, but today said that he's a little bit concerned by those integrity comments. Again, this stock absolutely plunging.
Abby, we thank you so very much for looking under the hood for us. And when it comes to tech, Jack Caffrey from JP Morgan Asset Management has not been impressed lately.
The Magnificent Seven, which I would suggest more recently has been more of a meh seven. When you look back over their lack of progress, any one of them has like a great week or two, and then two others are sort of putzing along doing a whole lot of nothing.
For more on tech and equities overall ahead of the election, we are joined by Sarah Hunt, partner and chief market strategist at Alpine, Saxon Woods, who we look to make sense of this crazy market. You think about what's happening in the tech world right now, and the semiconductor chips world right now as well. It's interesting to see Alphabet come out with a bang like that, really rise to the most you've really seen in months. But then you look at the semiconductor index. You look at NVIDIA, it's actually down today. A lot of people are watching what's happening with the read-through effect, with the spending and the benefits of AI. How are you thinking about kind of these cocktail of factors here?
Well, there are a couple of things that are going on that are both industry-wide, and then there are a couple of things that are going on that are individual to those stocks. So AMD is trying to catch up. And it doesn't look like that's going to be a smooth path. And I think also, even with the spending, we have to realize that for some of these folks, some of that spending is not going to be a straight path. And so there's going to be some lumpiness. And to the extent that some companies were criticized for the overspend last couple of quarters, I think that there is a tension in that. But I think what it really demonstrates is that this is not just a straight line. There's going to be some movement within it. But I think that Google will just set the bar pretty high for everybody else.
Yeah, it's pretty interesting because they set the bar high, but they also came off of kind of the weakest valuation, right, of that Magnificent Seven group. When you look at some of the firms that have been more highly valued from a price to earnings perspective, do you think that there's kind of a higher bar to clear, a much higher bar for earnings?
Well, the issue for Google also is that it's been under some constraints with concerns about issues with fines in the EU and other places. So I think that did give it some reason to move. And I would say that those revenues were much better than expected. And that really does help as well. I think that, you've got this issue with the growth has been tremendous. Can it keep up? That has been the refrain for the last year. The stocks have continued to move higher, although to your guest point earlier, not necessarily in a straight line. And while the Mag 7 was the story of 2023, in 2024, it's been much more uneven. But I think that there's a lot hinging on the growth of the technology sector in terms of what the world expects from S&P earnings for next year. So there's a lot of more scrutiny on that group right now than even other groups, because that is supposed to be the engine that is going to take us into the growth that we're supposed to see next year, market-wise, in terms of earnings.
Sarah, what do you think the election uncertainty is doing to the market at this juncture? What would the trade look like if we didn't have an election days away?
I honestly don't think that the market is taking the election enormously into consideration, to the extent that it now feels like it's pricing out an answer. I don't know that, one, we're going to get an answer as quickly as we hope to, because any non-answer or any longer time frame is going to be problematic for the market. But I also think that there is somewhat of a complacency in there's not going to be a huge amount of change. And, this is the first election where we've ever had two different, essentially not the exact same administration, but something where you've seen both administrations before. So there is some, I think, ability for the market to look through that and say, well, it was okay here, and we don't think there's going to be that much change there. But I do think that if you get, one red wave or a blue wave, that there will be some reconsideration, and that's not going to go well necessarily for equities, given the valuations that we see right now.
Right. I mean, one conversation we've been having is there's been this Trump trade under the market, and has been a strong Trump trade being pursued. Do you think that even if he were to win the election, some of those gains would be given back?
Well, I think it's a combination of potentially looking at a Trump trade, but also looking at the fact that the data has held up pretty well. We were worried about weaker economic data over the summer, and we saw some weak IP numbers, and we saw some other things over the summer that were much more worrying, especially on the employment front. And now that looks like it's been a little bit better. So I think that there's a combination of an expectation that you might have a less regulatory problematic environment under one administration, and the fact that the data is holding up pretty well, which is going to make it very tough for the Fed to make a decision, I think, next week, depending on what we get for the employment numbers, because the ADP numbers were much stronger than people expected. So that could add to the fact that we've got some good data underneath, and then we've got some potential for what people are expecting, a better growth environment if you have a less regulatory challenging environment.
Sarah, are you looking for buying opportunities in this earnings season? At this moment, do you have any Mag 7 stock that you would add to, whether things go in a better direction?
Well, we've been sort of saying all along, you can't get out of technology entirely, but to the overweight that it has been to the market can sometimes be to your detriment. So I don't think that we're necessarily looking at adding anything specific right now on an earnings season's kind of pullback. I think you need to see the market a little bit reprice itself before you want to get deeper into that trade. And I think that you're starting to see some valuations. I mean, Alphabet, to the extent that it was the less higher valuation of the group, is showing some really good performance here. Whether or not everybody else can do that, and or they can get the revenue growth to do that in this quarter, even if there was a little bit of a pullback, I think you have to wait and see what the market does. And I think you want to get through the election and see how the market starts to interpret that, because right now I don't think we're getting much of an interpretation.
And there's another set of companies pretty interesting in this market. You have Exxon and Chevron, big oil companies, starting to report at the end of the week as well. How are you watching that trade? I know we've talked about it before. It's been a finicky trade in the market.
It's a difficult trade right now because I would have argued back a few months ago that there wasn't a lot of political premium put into the oil price on what's going on in the Middle East. But then when it became somewhat clear that, at least for the moment, the energy infrastructure was off the table, I think that took more wind out of the sails of oil. And now you've got this interesting dichotomy between lower oil prices with the oil market that is expecting less growth, and yet looking for growth across the globe into 2025 on the earnings front. So there is some tension there, and which one of those wins right now? It doesn't look like it's energy, but I still think energy has a place in the portfolio. They've got some very good dividend yields, and I think longer term you're going to see much longer tail on hydrocarbons than we were baking in a few months ago or a few years ago. So I think that there is room there, but right now it's just uneven because of where the oil price is.
Sarah, we thank you so very much for your time on a very, very busy earnings day, and so much more where that came from still. That is Sarah Hunt from Alpine, Saxon, Woods. And speaking of energy, coming up, we're going to get to check on the industry from Will VanLoh. He's the CEO and founder of Quantum Capital Group. A lot of money coming into funds there. We're going to talk about it next. This is Bloomberg.
We will quickly become energy independent, and we will frack, 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 and drill, baby, drill. We're going to drill, baby, drill, and frack, frack, frack.
That was Republican presidential nominee Donald Trump making his stance on energy known at a recent rally. U.S. oil, gas, and renewable resources have been key topics of contention during this election cycle. The sector has performed well over the past year, and firms like Quantum Capital Group are investing in the industry, and Quantum itself raised more than $10 billion for its diversified energy investment platform. We're going to talk about where all that money is going. We're going to talk about this with Will VanLoh, CEO and founder of Quantum Capital Group. You know, it's interesting. You look at the different energy policies of both parties. How does this change your thinking ahead, depending on who might win the election?
It's a good question. We get that asked multiple times a day, as you can probably imagine. I think it really is not going to matter a lot per se, because we do invest across the entire energy capital stack. So we do everything from oil and gas, renewables, and kind of everything in between. So I do think that presidents and policy can influence to some degree, but probably not as much as people think it might. So
what's the margin, you think? Because you have the Democratic administration here really pushing the renewable energy policy a lot. Does that sway you in that direction further? And if not, then do you go into the drill baby mode?
Well, we are a very large driller, so I'd say the vast majority of our capital does go into oil and gas, and it does because that's where the best returns are. And so, America is energy independent today because of the shale revolution that started about 15 years ago. But we're also one of the largest producers of wind and solar energy today in the world. So I think the nice thing in America is we've got the optionality and opportunity to do both. And so I think, we will continue to do both, but we'll continue to kind of always focus first and foremost on returns.
So, Will, you're based in Houston. You're here on a tour to talk to investors. We just said you raised $10 billion. How does that compare with what else you're seeing out there? Historically, has this been harder or more easy to bring money in? What is the tone like from investors?
It has been the toughest fundraise we've been through in our 26-year career. So it took us almost 2 years to raise this capital. And so I'd say in the past that might have been a 6 to 12 month type time period. But investors in many parts of the world, especially places like Europe, on the coast, on the east and west coast of the U.S., many have actually kind of turned their back to traditional fossil fuels. And so because that's a lot of what we do, it's become much tougher. And I think climate change and ESG are just a big driver of that.
How does the size of the fund compare? Because even though it might have been more difficult to raise money, and by the way, we should say it's been difficult for any private equity firm to raise money right now, $10 billion, are checks just getting bigger at this point?
They're not getting bigger. No, and we raised it was a couple different pools of capital. So our flagship fund was $5.25 billion, and that compares our prior flagship fund was about $5.6 billion. So it was actually a little smaller. But then our structured capital fund was $2.8 billion, and our last one was $1.6 billion. So, some investors kind of prefer a little bit, maybe more of one flavor or the other. And then we raise some additional capital that goes more into kind of like direct investing.
How do you think about deployment at this juncture? How fast are you putting that money to work? Where are you putting it?
It's the best investment environment for traditional energy we've ever seen. And so we just had our final close, and we're already more than 50% deployed and over 80% committed in our flagship fund. So great opportunities today. And a lot of that's because of the capital that's being restricted, because so many investors are fearful about going into traditional energy.
Well, to that end also, one fear is what the M&A landscape might look like. You saw this very robust M&A landscape in the last couple of years. Do you think that hits a wall? Do you think it opens up? How much does the election matter there once again?
Yeah. Well, so I think we've seen a record amount of M&A in oil and gas over the last couple of years. Last year there was over $190 billion. This year probably won't quite top $100 billion, but it'll be very significant. And that normally averages about $50 billion a year of M&A. So that's big. I think on the renewable side, you're not seeing near as much M&A there. You're just seeing a tremendous amount of investment going into that space.
I got to ask also, the other hot topic, Will, is AI.
Right.
How is that changing your job and where you're looking to invest?
Yeah. AI is transforming everything. From our business standpoint, it's giving us amazing tools to help us meaningfully reduce risk and enhance returns. So that's something we've been very active across our portfolio in terms of implementing machine learning and AI, in terms of our investing and building tools for our portfolio companies to use it. But it's also a huge driver of energy consumption, right? And if you look at in the United States over the last 20 years, we've roughly had flat electricity demand. And over the last year and a half, with the introduction of ChatGPT and so many of these other AI and machine learning applications, we're starting to see electrical demand go up, 1.5% to 2% a year, and that is profound because the United States is not ready for that. We're not ready for that massive increase in demand for electricity.
Well, we have to leave it there, and I didn't even get to ask you about the N-word, nuclear, a hot topic these days. Will, we thank you so much for visiting us here in New York. That is Will VanLoh, CEO and founder of Quantum Capital. Now, coming up, the Trump trade and ETF flows have driven the price of Bitcoin up. Ahead of next week's U.S. elections, Bitcoin, gold, the dollar, you're seeing the trade all over the place. We're going to talk about those Bitcoin numbers in the weekly ETF report next. This is Bloomberg. This is Bloomberg Markets, and I'm Sonali Basak. It's time now for our weekly ETF report, where we're going to check in on the latest news, flows, and trends tied to exchange-traded funds. U.S. Bitcoin ETFs on Tuesday saw more than $800 million of net inflows, one of the biggest daily hauls since they launched. Year-to-date inflows for the group of 12 funds now sit around $23 billion. James Seyfarth with Bloomberg Intelligence is with us from Princeton to discuss. And you look at the inflows that you've seen, and is there anything unusual about the way you've seen these flows and the price movements along with them? I mean, it's a very significant amount since they've started.
Yeah, I mean, these things they took in tons of money. Like, they launched in early January. They took in tons of money in March and April. Obviously, they took in a ton of money right when they launched. But the last 13 days have been kind of extreme. I mean, 12 of the last 13 days have been inflows, and the total inflows are just shy of $5 billion. So we're at like $4.8 billion that have come in just over the last 13 trading days. So I think some of this is momentum chasing, obviously, as price runs up. Some of this has relation to do with the Trump odds of victory. People I think that a Trump victory would be good for Bitcoin. I don't know exactly what's causing it, but there's a lot of demand coming into these ETFs, for sure.
So how does this compare with what else you're seeing in the crypto world? Because the standout you've seen between Bitcoin and Ethereum has been pretty significant here. Is it because Bitcoin alone is part of the Trump trade?
Honestly, no, it's definitely not that. So it can't just be Trump, because in my mind, Ethereum might actually benefit more potentially from Trump victory. You can make that argument, right? But Ethereum ETFs as a whole just are not seeing the same level of interest. I mean, you talked about 23 billion since those things launched in January. Ethereum ETFs launched in July, and technically they have a net outflow of $500 million. So the demand is just not there on the Ethereum side of things. There's a lot. I could sit here and talk for this entire segment about why I think that is, but some of it just has to do with Ethereum being somewhat more complex. People understand Bitcoin a lot easier, right? It's just digital gold, digital store of value. It's a bet against currency debasement, all of these different things. And then you look at Ethereum, and is it, a tokenization platform, a digital app platform? Who knows? There's a whole bunch of ways you could describe it. And it's just, I think investors just aren't ready and fully equipped to understand what's going on there. And Bitcoin is one of one as far as most people are concerned.
So James, are these flows sustainable?
That's a good question. So what makes a good ETF category and shows strong growth? We tend to see times like this, spikes of inflows over weeks, days, maybe even months, and then there are going to be periods of outflows. But over the long term, what you're looking for a successful ETF category is that trend line is going up and to the right. And there are going to be dips where things go down meaningfully, but if it's going up and to the right, that'll be successful. I think that is where Bitcoin ETFs are heading. I mean, if you look at gold ETFs, they've had a very successful year. Obviously, gold has done well. They have 130 billion in assets. These Bitcoin ETFs are already at 72 billion in assets. So there's definitely more room to run. I mean, when you talk to most people in our world, right? If you talk to most people in the TradFi world, Sonali, they're very skeptical of cryptocurrencies. A lot of people really still do not take Bitcoin seriously. I mean, heck, most of our colleagues and coworkers don't take this space seriously. So there's still plenty of space for this to run if that many people just think of this kind of as a joke in a way.
At the end of the day, are there actually buyers of these ETFs that have been outside of the traditional types of buyers? I know when they came out, there was a lot of conversation that this would open up the channel for financial advisors, maybe even endowments, other institutions. What are you seeing?
Yeah, so I mean, we have seen institutions come in and buy. They've been like kind of a small percentage of the buying. Realistically, a lot of the buying has actually been hedge funds, your Millenniums of the world, your Citadels, and they're likely doing arbitrage trading, a basis trade against the futures market, so they'll go long the ETFs and short the futures market. So there is a lot of that happening, and that's what a lot of people will point to. But when you look at actual end investors, like your advisors, your endowments, these are some of the most successful launches that we've ever seen with the amount of money that has poured into these ETFs from that space. Yes, it's probably less than $3 billion. We'll know more who actually bought these things when we get the 13F report in the middle of next month. So all we know is who bought through June 30th of this year. But for the most part, there's almost $3 billion that have come in from the advisor community, for example. Yes, that's a small percentage of that $72 billion number we talked about. But that is by far the most successful ETF launch. Usually you don't see advisors like that type of money pour in until there's like a significant track record, sometimes 3 years. You need all these different hurdles to hit before these people start to invest. And yes, again, as I said, this is a small percentage of the buyers. It seems to be a lot of retail at this point, but there are significant advisors and traditional investors that are coming into the space.
James, thank you so much for keeping an eye on all of this with us. We love your analysis here. That is James Seyfarth of Bloomberg Intelligence. Let's check in on the market here as well, because, of course, it's been a really interesting trade out there. Even though you've seen some promising results out of the likes of Alphabet, we have had, of course, a mixed trade in the NASDAQ 100, down now 0.2%, but off of session highs in the S&P 500. This is Bloomberg. Welcome to Bloomberg Markets, and I'm Sonali Basak. Let's get a check on these markets. We have the S&P 500. We are now off of session highs, but still higher on the day. We're looking at a 0.2% higher move there. The NASDAQ 100 still in the red, maybe not as much as before, but 0.2% lower. You're seeing the 2-year standing at 4.13, the 10-year at 4.24, essentially flat after some strong economic data this morning. We're going to look under the hood, though, because it's big earnings season and there are some midday movers on the equity side. We're going to talk to Bloomberg's Jess Menton for that.
Sonali, I was watching healthcare because that had been the worst performing sector earlier this morning, but has since paired those declines, as well as Eli Lilly after its earnings call this morning, because its CEO said that demand for its obesity drug wasn't as bad as what investors were thinking there. So you're seeing that stock pair those declines down a little over 7% after dropping as much as 10% this morning. But looking underneath the hood at some other individual shares that are moving right now, specifically looking at Reddit, because we had those earnings after the bell yesterday, that sales outlook for the current quarter beating those expectations. Looking over at that stock, up and surging actually close to 39%, so on pace to close at a record high after it went public back in March. Of course, Snap is benefiting from what's happening with that ad revamp as well. Looking over at that stock too, up almost 14% in afternoon trading. Of course, Heinz, though, unfortunately, when you're looking at what's happening with its earnings results, it actually tempered its outlook for growth as far as when it comes to this year, but then also anticipates growth to be not as high as expected for next year as well. So you're seeing that stock pressured. And of course, can't forget the burrito chain Chipotle. Its earnings were after the bell yesterday too. So you're seeing that stock pressured as well, down over 7% after there was a really high bar to meet those expectations. But of course, with under a week to go ahead of the election next week, looking at DJT, volatile once again after it did have 5 separate halts earlier this month through yesterday, though. But it's down actually close to about 20% right now. But still, if you look month to date, it's up close to about 160%. So that would put it on pace for its best month in about 3 years if it can hold on to those gains. But once again, pretty volatile right now, Sonali.
Jess, we thank you so very much for keeping an eye on all of it for us. Speaking of the election and those stock movers, UBS is seeing its stock sink in today's section. It warned of uncertainty in the final quarter of the year. Earlier today, the company's CEO spoke about trading around the election.
The markets are pricing rather a Trump victory, and think that if this is confirmed, it remains to be seen. Is a classical sell-on news event, or how he wins will be also determining, is he in control of the Congress. If Kamala Harris wins, of course, some of the trades that are ongoing for Trump will probably have to be reconsidered, and therefore they're going to create rotations in the market.
And for more on global markets, we are joined by Principal Asset Management Chief Global Strategist, Seema Shah. And you look at this earnings season, there is a lot of noise, isn't there? I mean, we're just getting started on that Mag 7 stretch. What do you see so far that gives you a catalyst for something new?
Hey, Sonali, great to be on with you. So, yes, I mean, I think at the moment you can see that there's so many different factors playing in at the moment, of course, including the US election, but then also uncertainty around what the Fed is going to do, the strength of the economy, data being a little bit compromised when it comes to the labor market. So there's a lot in the mix at the moment, which is, I think, making it really difficult to decipher, and probably a little bit more worrying is I think it makes it a little bit more difficult for policymakers to decipher the strength of the US economy. And then, of course, it makes it cloudier for investors to figure out what is the path forward.
You know, it's funny. Tuesday, I walked into work and I said, oh, my God, we're a week from the U.S. election. Today, I walked into work and got a note from a fund manager saying we're a week from the FOMC meeting. So there are a significant amount of catalysts ahead. You had that strong economic data, to your point, this morning, and the market is pricing in less than one rate cut at this juncture when it comes to that meeting a week from now from the FOMC. So what happens to the market if we don't see that rate cut?
Oh, goodness, if we don't get that rate cut, I think it's going to be adding a ton of volatility, taking out a lot of the positive sentiment that has been driving the market. And of course, look, maybe it's driven by the Federal Reserve's perception that the US economy is really strong, but the market really needs a couple of rate cuts to keep that sentiment, at least the investor sentiment, fairly positive. The other thing is I think the Fed is running a bit of a risk here that, they've said all along in the run-up to the most recent meetings, saying that they don't have a stop-start cycle. They also did a 50 basis point cut in September, which arguably could have been a bit of a mistake. So if they don't cut in next week's meeting, despite maybe some cloudiness of data, I think it doesn't really add to Fed credibility, and that will add additional tensions for the market.
Right, this idea that did they lock themselves into that forward guidance? What is the crossover right now between asset classes? If you see rates stay higher because of all of this strong economic data, then what does that mean for the equity market?
Yeah, and it's been really interesting because with the bond market, with yields rising, and the equity market has digested it pretty well. And I think one of the reasons is that it's still quite unclear what is driven by a Trump trade and what is driven by stronger economic data. Unfortunately, there is a point, though, where the bond market, or at least the equity market, can reach a tipping point where bond yields rise a little bit too far, and then the equity market starts to get a little bit worried. And this is where earnings season becomes extra important, because valuations we know are very, very stretched. The higher yields are, the more difficult the equation becomes. So earnings absolutely have to deliver. And of course, we're in a week where we're seeing a lot of news come in, which could be one of the many factors, but at least a key factor which drives the direction for markets for the next couple of weeks at least.
It's interesting as well to see the data this strong just this morning. You can remember the time where the market was hanging on every data point. It looks like people have chilled out just a little bit here, but we still have jobs on Friday as well. So how much sensitivity is there to the data at this juncture? And what are you watching most closely for your signals?
So I think that sensitivity is there, but I think the market is also aware that right now the labor market data is so difficult to understand. There's the strikes, there's a hurricane effect, there's actually the fact that response rate as well to labor market surveys have dropped fairly significantly in the last couple of years. So I think the market is almost treating it with a pinch of salt and saying, look, yes, we did see the ADP number fairly strong. We want to see what the payrolls number is. We're expecting maybe 100,000 impact from the strikes from the hurricane. So maybe giving it a little bit of space and saying, let's actually wait to see what happens in December for that data before we start to get a clear read-through of the labor market. So I think that sensitivity is there, but I think the market is also saying we know that at the moment the labor market isn't entirely trustworthy.
Well, to that end as well, what do things look like when we start to expand the horizon a little bit for people who are maybe looking for a pullback, for people who are looking to invest longer term through these valuations? What are the risks? Because to the extent that you are worried about the election and the way the economy could change after that, what could change?
So I think this is a key point as well, is that valuations we know are very stretched. We also know that over the last 20 years, using valuations to drive your positioning would have been a horrible mistake. So we have to keep that in the back of our mind. But the other thing is that when we come to elections historically, you don't really see that much of a sustained market impact, unless, of course, you get major changes to fiscal policy, major changes to regulation. Certainly from our perspective, we're not entirely sure that there's going to be really sweeping changes from the election. So you're seeing a lot of volatility in the run-up, and maybe in the weeks, months after that starts to fade out. So from an investor standpoint, it is really important to take a step back, try and look through the next couple of months of the election, the labour market data, which, as I said, is fairly compromised, and start to think about what are the fundamental aspects of the economy. And when we look at that, the clear thing that we continue to see is that, look, household balance sheets are still pretty strong. There is likely a slowdown coming through, but corporate balance sheets also in pretty strong shape. So even if there is something about the economy which is weakening, it doesn't take too much to be fixed. So some Fed cuts should be sufficient. And from that perspective, it is still a space where the equity market can continue to perform fairly well. Probably not as strong gains as you've had in the last year or beginning of this year, but it's still a fairly positive outlook going forward.
You know, it's interesting. You have the 10-year standing at 4.24 and a lot of dispersion with where investors expect that to land, even at the end of next year, let alone in the next couple of years. How much control does the Fed really have on the long end right now?
I mean, it's a great question, particularly when you're going into a year where there's going to be so many discussions about whether or not the tax cut's going to be extended and by how much. And I think that bit of additional volatility, that term premium, which is going to be added to the market, probably means that although historically when the Fed cuts rates, 10-year bond yields do trend lower, when you add in that dimension of the fiscal discussion, the fact that it's going to be dominating headlines through 2025, you're probably going to see 10 years stay somewhat elevated. Now, how far it goes, as you said, there's a lot of dispersion in terms of those forecasts. From our perspective, we think that 425 at the end of 2025, almost where it is today, actually makes sense. But with a lot of movement, a huge amount of range trading throughout 2025.
Seema, we have to leave it there. We thank you so very much for your time. Of course, really complicated market we're looking at here between the economic data and the earnings. That is Principal Asset Management Chief Global Strategist Seema Shah. Now, coming up, we're monitoring shares of Supermicro. Another shoe drops in the ongoing scrutiny of its accounting practices. It's going to be our stock of the hour next. This is Bloomberg. This is Bloomberg Markets. I'm Shonali Bassick, and it's time now for the stock of the hour. We're watching Supermicro's shares are falling dramatically today. Ernst & Young has resigned as Supermicro's auditor. This comes in the middle of a review of the company's accounting practices. For more, we are joined by Bloomberg Technology co-anchor Ed Ludlow. And there's been a very stunning series of events when it comes to Supermicro, and a lot of volatility around the stock. Put this into perspective.
Well, any public company anywhere in the world that sees their auditor resign and make a statement that they have concern about the integrity and ethics of a management team and audit committee, that is very serious. So the decline on the stock is, I think, puts it on track for its biggest drop since 2018. But you're right that it's part of a sequence of events. Basically, around Supermicro, there have been accusations and concern about accounting practices for quite some time. In 2020, they settled a probe with the SEC, and it all kind of resurfaced this year when in April, a former employee accused them of exaggerating or misstating revenues. That then led to Hindenburg, the well-known short seller, publishing a report, and more recently in September, reports that the DOJ is looking into it, all putting downwards pressure on a stock that has been just sort of hyperbolic in recent years and gains.
Let's talk about what this has meant for the company's stock throughout the last year, because over this year, you've really seen it up around 15% still. It's still up on the year, but you're seeing it down more than 70% since the highs. There was a tremendous bid in this stock before these problems.
Yeah. I mean, in full year calendar 23, it's a stock that I think gained 250%. You know, it's had momentum. I don't know if the control room can bring up Dell and HPE as well, but the story is quite simple. All the data centers we keep talking about in the AI context, Supermicro is one of those names, along with Dell and HPE, that assembles the servers. You don't just buy chips directly from the chip maker like NVIDIA or AMD. You kind of need an intermediary. And so it was just logical that if we were going to invest in new data centers or update them with these AI chips, the server assemblers would have a role in that. And that's been a driver of the stock. It's also, conversely, why you see Dell and HPE markedly higher. because we don't know what the impact of this will be. Supermicro said that they won't retroactively restate prior stated financials, but they have earnings November 5th. Will they lose market share as a consequence of this? We just don't know.
That's absolutely what I was going to ask next. What do we know about the earnings report, if anything at all, and how they plan to address any of this? And has the short seller said anything?
Yeah, well, to my knowledge, the short seller hasn't said anything beyond what was already in the existing report in the month of August. That is the accusation, though. It's largely based on the historic claims of that former employee and accounting practices. November 5th, if you don't mind me stating, is election day in the United States. Their earnings call or statement of earnings will be after the market close on November 5th. That's timing for you. Don't really know what else to say. We have to wait and see. It's one of those situations.
Timing is everything, don't they say? Ed, we thank you so very much for your time. That is Bloomberg technology anchor Ed Ludlow. Wish we could talk about everything with you. A lot of interesting fundraisings in the market, a lot going on in AI, but of course, a big story of today. Now, coming up, the housing crisis is a key issue in the U.S. elections. Our next guest is strategizing investments in affordable housing for years to come, despite who's in the White House. This is Bloomberg.
So under my economic plan, we will bring down the cost of housing and help first-time home buyers, giving them $25,000 for down payment assistance so you can just get your foot in the door.
That was Vice President Kamala Harris making her pitch to voters. The U.S. housing market has become a pretty critical focal point here in the 2024 election. Private investors are planning to navigate the sector no matter who the next president is, but the plans are certainly different. We're going to talk more about this with Laurence Gottlieb. He's the chairman and CEO of Fundamental Advisors, a firm that specializes in public purpose assets, municipals, and you have this very close view on what's happening in the housing market across the country. It's incredible how much it's impacting voters because, of course, they have not seen the ability to buy new houses. She wants to build 3 million homes, more than what's in the planned supply upcoming. Can she do that?
Well, look, first of all, thanks for having me. Great to see you again, Shonali. I would say bipartisan support exists for to support the need for housing, affordable housing in our country. And we have focused on those markets, and we do see opportunity abound in those markets. Federal policy is one layer of it, and it's our hope, it's our expectation that either candidate would be supportive of the need, the real need. It's just a fact. Our supply is insufficient for the demand in this category, which is good for us as investors. Your question, can she build 3 million new houses? We hope so, because that would address a need, and we would certainly be all over that. But we see that across the aisle. We see that both red team and blue team is focused in an area that needs national attention. I would say it's a local game, though. It can't just be at the federal level. Fannie, Freddie, HUD have a role to play. But we find that the activity set is very local and state specific.
Yeah, let's talk about both of those things. First, Fannie Freddie for a moment here, because if Trump were to win the presidency, in his last term, there was a lot of conversation about the potential privatization of Fannie Freddie. Is that something that would be possible in the next Trump administration?
You know, you're looking at entities that have huge bureaucratic history, that have huge roles to play in the markets that they serve. For my entire career, I have known this landscape. Is it possible that change could happen? Of course it's possible. But you might even say that that would be rational. If you were to build it new, would you build it the way we have it right now? Probably not. But what we have has real roots. It would be difficult to make those changes, not impossible. We'd be prepared to act in that environment. I will say, because of the bureaucratic nature at the federal level, we have a role to play in providing important development capital to developers who might be smaller or medium sized and can't navigate that complex labyrinth that exists in the marketplace.
So let's talk about the market on the local level, as you had mentioned. Give me your playbook. How do you approach this on a very local level? Before we started this discussion, you were kind of telling me earlier that you are traveling the country a lot. You're doing this state by state.
it's a local game. Just getting back to what we were saying a moment ago, it is supported by the secondary market and the capitalization that exists, particularly in Fannie Freddie HUD. But the execution of a project is literally at a project-by-project basis. You have tax-exempt bonds, which is our specialty. You have low-income housing tax credits, and that must be navigated at a very local level, which makes it somewhat inefficient, which means some of the bigger players choose not to play as much in the affordability sector where we specialize, which the Vice President was speaking to just before our segment.
Well, the affordability sector here really requires cities to be involved. Where are you seeing the most success when you look across the country?
You know, it's mixed. We have focused all over. We don't have a particular view on a particular jurisdiction, but there are areas, for example, California and Colorado recently have made significant moves in affordable housing, both successfully, I might say. There's a need for it everywhere, and you've seen, it depends. You know, there's differences between Section 8, between LIHTC assets, and all the way up to market rate assets. So there's variability in different sectors, and one of the things we rely on is our 18-year now history of providing our investors that oversight of the different sectors out there, different jurisdictions.
Now, I want to switch over and talk about another theme. We had somebody on earlier in this show to speak about the energy needs in this country. Sure. There has been a lot of conversation about that on the campaign trail as well. How does the renewable energy trade in particular change if Harris does not win the White House?
Well, we shall see. We have a well-developed practice in renewable energy. We lend primarily to late-stage development and construction of solar, primarily, assets. We've been at that for more than 8 years now, $6 billion invested. We provide needed capital to that area. The IRA, the Inflation Reduction Act, was very catalytic. But it was a nice to have, not a need to have. I think the biggest thing it may have provided is certainty as to the duration of the investment tax credit, which again I think has bipartisan support both from Republicans and Democrats. There is agreement that we need to transition away from fossil fuels and towards renewable. That we know. Execution is where it's at, and I think what we're seeing right now is a real move towards solar, which is in many states cheap to deliver to the grid. I'll say that again because I think it's important. Solar energy is cheap to deliver to the grid. That's something of a development in this space, which I know you're familiar with.
You have like 30 seconds left, but I do want to ask you, do you see distress popping up in this market? There's so much talk about a strong economy, but you almost can't believe that some things aren't left behind.
We do, and we're specialized in distress. Again, 18 years of doing that. What I would say is seniors care had frozen debt capital markets. That meant that it was harder to bring assets to market. It was harder to recapitalize assets. So that's an area we're seeing some distress popping up and elsewhere. So we're excited about those opportunities.
Laurence, we thank you so very much for your time. That is Laurence Gottlieb, Chairman and CEO of Fundamental Advisors. I want to also check in on the shares quickly of Airbus. Some breaking news. They're gaining after announcing earnings, reiterating its goal for aircraft deliveries in 2024. The CEO is on the close later today. You're not going to want to miss that conversation. I'm Sonali Basak. That does it for Bloomberg Markets. Fascinating day in markets and a lot happening after the close. Earnings season is on. This is Bloomberg.